Hello everyone, welcome to your Algo lab. Today we're diving into macro Algo. We'll explore US non-farm payroll and see how you can use it to make your investment decisions. Without further ado, let's jump right in. The non-farm payroll is calculated by the Bureau of Labor Statistics, BLS, and released in the Employment Situation Report, usually on the first Friday of each month. This report is a key economic indicator that can greatly impact financial markets. Why is it important? First, 68% of US GDP is driven by consumption, which is tied to employment. Second, the report is timely, released just a week after the month ends. Third, it offers detailed insights into the labour market and household earnings, useful for predicting future economic trends. The non-farm payroll survey is sourced from business establishments, not households. The Bureau of Labor Statistics, BLS, contacts 440,000 corporate and government work sites. These sites employ over 50 million workers, representing about 1/3 of the total non-farm workforce. We need to create a rule to use non-farm payroll as a systematic signal. According to various analyses, the US economy must generate 2 million jobs annually to keep pace with its growth and the influx of new job market entrants. Based on this, we'll design a rule. We'll calculate a 3-month moving average of the yearly change in non-farm payroll and use the 2 million job threshold as the trigger for our signal. For the exit signal, we'll use one of two criteria, either a recovery of 500,000 jobs in the 3-month moving average from its lowest point in the past 12 months, or an improvement in the 3-month moving average above the 2 million threshold. Now, let's test how this set of rules performs across each asset class since 1980. First, let's examine the recession trigger date and compare it to the SARM rule that we analysed in Macro Algo Episode 2. We observed that the non-farm rule can signal an impending recession, similarly to how the SARM rule does with the unemployment rate. The trigger dates for both rules are quite close. However, when it comes to the exit signal, the non-farm rule suffers the same limitation as the SARM rule. It often signals a recovery too late. Additionally, there are several false signals that last only 1 or 2 months. Nevertheless, the non-farm rule holds value, as no single indicator is sufficient to assess the economy. A combination of multiple indicators is necessary for a more accurate analysis. For the S&P 500, the results are inconsistent over time. One reason for this is that, as mentioned earlier, the non-farm payroll signals downturns effectively, but tends to lag during recoveries. By the time the unemployment rate begins to decline, the equity market has often already recovered its bear market losses and posted gains. Despite the delayed exit signal, the non-farm rule successfully allowed the investment to participate in nearly the entire 1990 rally, while avoiding the most volatile periods of the dot-com crash and the global financial crisis. We also observed that the rule is effective in global markets. Now let's turn to global fixed income. Government bonds typically perform well during economic downturns, with US Treasuries averaging a 6.26% return during past periods of low non-farm payroll figures. Let's examine the impact of low non-farm payroll figures on commodities. The results appear mixed. Commodity prices often face pressure during periods of low employment, but in some cases prices quickly hit a bottom and rebound. This suggests there are other underlying factors at play that need to be explored. When it comes to currencies, the results are mixed as well. The best performers are the Japanese yen and Swiss franc, known for their safe haven status. For cryptocurrencies, the limited historical data makes it difficult to draw meaningful conclusions. To summarize, US Treasuries, along with gold and oil, tend to perform best during periods of low employment, while US equities and the US dollar show more mixed results. As noted earlier, using the non-farm rule to trigger trades based on low employment can effectively signal the start of an economic downturn, but it's not quick enough to signal a recovery. The frequent false signals suggest that the non-farm rule cannot be relied upon alone. We'll explore additional indicators in future episodes. Don't forget to check out our other videos. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest releases. Thank you for watching and see you next time.